I'm the Chief Economist and Multi-Asset Strategist here with Kleinwort Benson Investors. The title's quite a mouthful. And I suppose I've been with this company, since way back in 1988, doing a similar role, although obviously it differs from time to time, but always on the macro side, and more recently with some fund management and asset strategy responsibilities as well. Kleinwort Benson Investors, until recently, was known as KBC Asset Management. It was bought by RHDI Group, which is the parent of Kleinwort Benson. It bought us from KBC Group. We were previously KBC Asset Management, as I mentioned, last October, and then it was under KBC for the previous 10 years or so. It was actually, if you go way back to 2000 and beyond that, it was part of Ulster Bank Group. So I've actually had three owners here, same company and similar job. We have three, if you like, buckets of products here. And they're all roughly equal in size. We have a high dividend equity strategy, which is very successful internationally, especially, and here at home as well. We have environmental equities as the second bucket, where a lot of focus on water, alternative energy, agriculture, and some combination products. Again, very interesting in sort of the SRI space, and also just on its own investment merits as well. Also quite successful. And then we have our multi-asset strategies. They're the ones I work on myself. These would be if you go back to a number of years ago, it would be sort of the standard pension managed fund, or PMF, that we're all familiar with in an Irish context. But obviously those funds have evolved a lot and are much more tailored to customers' needs than they would have been 5 or 10 years ago. Our flagship product in that space now is our Diversified Growth Fund, or DGF as we shorten it to, which is sort of a Mark II or new generation managed fund. It would have a lot of alternatives in it. It would use quite a lot of passive investment managers. Most of it is outsourced to various best-in-class managers around the world, as well as some active management, and we work with partners such as Mercer Global Investments and AccuVest on that fund and on other funds. So it's very much an outsourced model, and I suppose my role here, as well as advising on the macro and overall investment asset allocation strategy, is also to find providers here or abroad that we think can fit in within that fund. Also in the multi-asset space is the traditional pension management fund that I mentioned already. We also have a large alternative investments program here called Fusion, and a number of other tailored or customized funds for our clients that would have, by definition, multi-assets. So usually some mix of equities, fixed income, alternatives, very much so these days, property and so on. I think the impact of inflation can be overhyped, or the risk of inflation can be overhyped, I should say. We've all seen charts that show a huge acceleration in the monetary base or other measures of money supply because of central banks' actions, the emergency actions they've taken over the last 2 or 3 years. And there are many people out there that would say that's bound to spill over into a huge bubble or a huge inflationary problem first, I suppose. I'm not at all convinced. First of all, although that money, that extra liquidity, has been created by central banks, it isn't being used. It's the velocity of money, not to get into too much of an economics lecture, but the velocity of money has collapsed. So all that extra liquidity is out there, but it's out there because people want liquidity, whether that's the banking system or individuals. They want that liquidity. They're not looking for money to spend. They're looking or to use in the economy. They're keeping it in liquid form because they're nervous about the state of the banking system, and they're quite right to be. So unless or until that liquidity preference changes and a huge amount of extra liquidity in the economy starts to be spent and to be used instead of left essentially in very liquid format, until that happens, we don't need to worry. When it does happen, I think the central banks will have ample opportunity to unwind any of the various emergency measures that they've taken to put the liquidity into the system. So if you like, there was an extraordinary preference for liquidity that the central banks met by extraordinary measures. Once that extraordinary demand for liquidity diminishes, the central banks can take that liquidity away. Now, having said that, of course, we're in a world where we're 2 years past the recession in the US and similar periods elsewhere. Emerging markets arguably never had a recession in the first place. Growth is not great in the very short term, but growth is okay in most of the world. We do have very high energy prices, so there are inflationary pressures out there. I'm not dismissing them, but what I would say is that it seems to me they're fairly normal inflationary pressures that you would see in most cycles at this point, that can be dealt with by central banks putting up interest rates or taking other measures. So of course there's upward pressure on inflation, but it's not something I hugely worry about. I very definitely don't expect a double dip scenario, and that's not really in my thinking. Certainly we have seen a spate in May and the first week or two of June of weaker than expected numbers in the US, focusing on the US as it's still the world's largest economy and most important to the market, certainly. I don't see anything in that except a few transient factors. Some of it is a reaction to the Japanese earthquake and there's some difficulties, supply difficulties and bottlenecks in the auto industry, and a few other sort of small-ish once-off factors like that I think have combined to come together to bring growth down a notch or two. But look, that's quite normal. I mean, look at any economic cycle that I can think of in the last 20, 30, 40 years, and you've had quarters where growth has dipped to 1 or 2 or 3%, well, 1 or 2%, and usually followed by accelerating again either 1 or 2 quarters later back up to a 4% level, at least as reported by the official statistics. So I don't see what we're seeing really in the last few weeks is anything more than a temporary aberration, if aberration isn't maybe the word I'm looking for, but a temporary phase which is not that significant, particularly in the context where we believe that we are looking at subpar growth over the next number of years. Whereas I'm very definitely not in the double dip camp. Most certainly I'm not in the growth is going to be perfectly normal, the structural headwinds are gone away, there is no longer a debt problem and so on, and therefore we should have 3 or 4% growth, maybe 4 or 5% growth for the next year or two. I'm not in that camp either. So I start from the position that growth, not in any one quarter, but over, say, a rolling 2 or 3 quarter average is going to be, say, 2.5 to 3 in the US, maybe more 2.5 than 3. So getting a quarter or two where the number is a bit lower than that doesn't worry me at all. If I thought something had changed that would produce lower growth, I'd be more concerned. In other words, if we'd recently seen a major change in interest rates, if we'd recently seen a collapse of growth outside the US, or say a huge rise in the dollar that would affect exports, if we'd recently seen a very significant change for the worse in fiscal policy, then I would say, now we're getting slow growth, that's the effect, we can see the cause, which is one of those factors I just mentioned, so now we can believe that this slowdown is real. But the truth is that the lower numbers we've seen lately are not as a response to any significant change in policy or the factors I mentioned earlier, such as a strong dollar or weak growth overseas. So if there's no reason why growth would suddenly have changed to a much lower pace, then I don't believe it has, and I think you'll see stronger numbers in the weeks and months ahead. Not dramatically stronger, but stronger. I think clearly the euro sovereign debt crisis remains serious. I mean, as we speak, and of course this is a rapidly changing situation, but as we're speaking here today, it looks as if there still isn't a final deal for Greece. It looks as if certainly there'll have to be some kind of private sector participation in the bailout cost for Greece. Whatever, we can now, as we all know, get into semantics of default versus restructuring versus reprofiling versus participation, Vienna initiatives, and Lord knows what. But the bottom line is that Greece cannot pay its debts, and I don't think they're likely to be able to pay their debts in the near future. So clearly a solution has to be found to that. It simply has to be. Even once a solution is found for Greece, obviously the markets will, about 5 minutes later, then start to look at Portugal and Ireland. I genuinely believe that Ireland is in quite a different situation to Greece. There's obviously a bias that you think, are you just saying that because you're in Ireland? But I think quite objectively, if you look at our statistics versus at the way we have approached dealing with the crisis, as opposed to the way they've dealt with it, if you look at our openness to trade, which I think is a big benefit to us, our pro-business policies, our flexible labour markets, I don't think those are just cliches. I think they matter, so I don't think we're in the same boat. I also, however, think that the markets don't remotely care about that, frankly. So even though logically I might say Ireland is different to Greece, I do believe that minutes after Greece is sorted out, or there's some finality to that situation, the markets will surely look at Ireland. Now, we're not borrowing from the markets in Ireland. Obviously we're getting our money from the EU and IMF, not the financial markets, so in that sense it's a couple of years before we need to go back to the markets. We have a breathing space here, but nonetheless I do remain concerned that perhaps politicians in Europe, there's a political risk that politicians in Europe will say, we've sorted Greece in, say, July of 2011, we need to sort Ireland in August, not wait 2 years for them to go back to the markets to sort their account, and it's a mess. So I'm awake to that risk as well. But in overall terms, the euro sovereign debt crisis has not gone away. It looks like we're going to be with it for many months to come, and it is a very significant risk factor. Yeah, I mean, there were some parallels between, in a strange way, between the Irish property market and the Chinese property market. First of all, there was a belief in Ireland in the bubble years that the growing population, the influx of immigration, that there was a permanent factor that was going to support Irish property prices forever, and that they could never go down. And in some ways, people quote that a little bit in China as well. They say that there were so many people moving to the cities. I think the figure is about 20 million per year moved from the city, from rural areas into the cities. They all need housing. Private sector housing is still relatively new in China. 10 or 20 years ago, there really wasn't any such thing. So there's massive pent-up demand for housing in China, and that this will support China prices forever. Those are, I suppose, the parallels. However, in Ireland, I think that was, well, we know that was clearly nuts. It wasn't true, and in many ways it never could have been true. In China, to be fair, a lot of those arguments stack up a lot better. I don't think I would sit here from whatever we are, 6,000 miles away, and say definitively that there is massive demand in China that can never run out and that we'll get another 10 or 20 years of it. And in any case, property prices in China are affected by more than just the supply side. There are many other aspects. A lot of it, for example, is speculative demand as opposed to end user demand. But I do think or suspect that there is enough genuine demand from genuine end users in China that I don't really think we're in bubble territory in Chinese property prices. But I think the bigger issue is not necessarily property prices. I know that we tend to focus on that a lot, the markets do. But I think possibly a bigger issue really is fairly simple economic cycle stuff in China. The Chinese economy has got too hot. The authorities are taking measures to try and slow it down through higher required reserve ratios, through higher interest rates, administrative measures trying to cool the property market, and other things. And this is pretty simple economics. Either the authorities have misjudged it, they have tightened policy much too much, and they will cause a hard landing, or actually, as they've done now for 10 or, well, more than 10 years, for getting on for 20 years now, I suppose, in China, that they have managed this this overheating quite well, that they will bring about a soft landing, and it's a simple choice. I tend to favour the second. I think if you look at China's track record since it really moved or began the move to a market economy, they are outstandingly good at managing their economy. They managed to avoid a recession and they managed to avoid a crash or any real difficulties much during the Asian crisis in '97. And on several occasions since, when the rest of the world has been in real difficulties, China has managed its economy really well in a very stable fashion and without causing problems. So I think for us, for anybody to say that China has lost the plot, is making a mess, and is either over tightening or not tightening enough. I'm not saying that China will always get it right, but I'm saying they strongly deserve the benefit of the doubt at the very least. And I think you want to be quite sure that the Chinese are mishandling things before you make a firm judgment on it. And I would also say that they do have some of the, they do have the advantage that it is still in parts a command economy. If the Chinese authorities say stop lending, well, you better stop lending, or you might find yourself out of a job, or you might find yourself in prison if you're a bank official. So, it isn't quite the same as when, say, here in Ireland, the central bank might issue a press release saying, we think that on the whole maybe banks should pull in their horns a bit. Until very recently, post-crisis, but certainly pre-crisis, that press release, let's say, wasn't exactly given a lot of attention in the lending departments of the banks. Very different in China, and they have to do what they're told. So the government has the ability to change tack quite quickly and be very flexible, and can turn policy in a dime really very, very quickly. So I think at the minimum they deserve the benefit of the doubt. Yeah, I do post views on our blog here, which is blog.kbinvestors.com, where I try, sometimes I might update several times a day if there's lots happening, sometimes I mightn't update for a couple of weeks or more if there's nothing happening, but as and when topical things arise that I think are of interest, I tend to post there. So if you want to get a sense of what we're saying here, that's the place to go.